This is the Chapter 7 in-class problem. We completed the following transactions and we used a perpetual inventory system. On June 4th, we sold $650 of merchandise that cost us $400 to Natara Morris, terms net 15. So whenever we make a sale, there are two journal entries that we have to write. I'm going to see if I can squeeze all this stuff down here. So this is June 4, and we first want to record the revenue piece. So debit to, if this were a cash sale, it'd be a debit to cash, but it's not. It's a credit sale. So I'm going to go ahead and put the name in there. It's not completely necessary, but it is a proper way to do it. Okay, so for $650, and then we need to record the sales for the same $650. That's the revenue piece. We still have to record the cost piece. So that's a debit to cost of goods sold. It cost us $400, and we need to pull it out of merchandise inventory. Same $400. That's also June 4. Next, we sold merchandise to a customer for $6,900. It cost us $4,200. The customer used their credit card. So this is not accounts receivable. We still have two journal entries that we have to write, but it's not an accounts receivable. So first, on June 5th, we're going to write the revenue piece, $6,900. If this were a cash sale, it'd be a debit to cash, but it's not. Oh, no, I'm sorry. It is. Because a credit card is, we're going to treat it just like cash. So we're going to debit cash. If it were a cash sale, we would debit cash for the full $6,900, but it's not. This credit card company charges a 3% fee. So we're not going to collect the full $6,900. A 3% fee means we collect 97%, and the credit card company gets 3%. So $6,900 times 0.97. 6,900 times 0.97. That's 97% of 6,900. 6693 is what we are collecting. 6693. We're going to have a debit to credit card expense, and then we can record our sales of 6,900. So what's missing is the minus 6,900 is $207. There we go. That's the revenue piece. We still need to record the cost piece. That's cost of goods sold for $4,200 and merchandise inventory for $4,200. Next, we've got on 6.5. Oh, this is 6.5. 6.5. Next, we've got on 6.8. I'm going to make this smaller so I can, let's see, how do I do this? I'm going to make this, so I guess I'm going to have to do it like this. There we go. I'm going to make this smaller so I can work. It'll still be there. You can still see it, but give me more room to work. Next, we've got on June 8. Sold June 6th. Sold $5,850 of merchandise that cost us $3,800 to customers who use their credit card, 2% fee. So again, If this were a cash sale, we would hit cash. It's a credit card sale, we're going to treat it like cash. So we are going to debit cash. If it were a cash sale, we would debit cash for $58.50. But it's a credit card sale, so we're going to have a credit card expense before we put that sale in there. The sale is going to be $58.50. The cash, we're not going to collect the full $58.50. They charge a 2% fee, so we're only going to collect 98% of $58.50. $57.33. And the difference, $117 is our credit card expense. It's just the first piece. We also have to write the cost piece. Cost of goods sold for $3,800. Merchandise inventory, $3,800. Okay, 6.6. I'm gonna make this small too and tuck it over there on the side. There we go. Next, we've got 6.8. Sold $43.50 of merchandise that cost $2,900 to customers who use their credit card. Credit card charges a 2% fee, so we're getting pretty good at this right now. First, we're going to record the revenue piece. This is a credit card, so we're going to record it to cash, but we also know we've got credit card expense. And then our credit's going to be the sales. Let's see, it's $43.50. That's what it would look like if it was a cash sale. But $43.50 times, what is this? Excuse me, 2% fee, so we're collecting 98%. $42.63. And the difference is our credit card fee. And that's the first of two. The second one is cost of goods sold for $2,900. And merchandise inventory for $2,900. On 13, wrote off the account of Abigail McGee against allowance for doubtful accounts. The $429 balance was from a credit sale last year. So last year, we sold McKee $429 worth of stuff. Now we're in June of this year, and we've given up. We're going to pull that $429 out of accounts receivable. If this were the direct method, we would hit bad debt expense for that $429. And we would credit accounts receivable for the same $429. If it were the direct method, this is not the direct method. We're using the allowance for doubtful accounts account, so this is an allowance method. That means we already put some amount into bad debt expense last December 31st. It was a debit to bad debt expense for some amount and a credit to the ADA account, allowance for doubtful accounts account. we put that credit into the ADA account so we can use it in the following year as customers go bad. So here we're going to use some of that up. Allowance for doubtful accounts is going to be our debit for this 429. And then June 18. Received Morris's check in full for the June 4th purchase. Oh, so up top, $650. So we're going to record the cash in for $650, and we're going to reduce the accounts receivable in the name of Morris for the $650. So that shows that Morris no longer owes us. Next problem. We began operations in year 1. During our first 2 years, we have a number of transactions involving sales on credit, accounts receivable collection, and bad debts. Transactions are summarized as follows. So we've got year 1 activity and year 2 activity. And it looks very similar. We've got A, B, C, D, and E, F, G, H. We've got credit sales. We've got credit write-offs. We've got credit collections. And then we've got the end of the year adjustment for the allowance for doubtful accounts account. That also says the company estimated that 1.5% of accounts receivable would be uncollectible. So it doesn't tell us, oh, maybe it does down at the bottom. Yeah, it does down at the bottom, but it doesn't have to tell us. It tells us down here that we use the percent of receivables method, and it doesn't even use it in that language. It doesn't even say it in that language, but we use the percent of receivables method. We can figure that out from right here. We estimate that 1.5% of our accounts receivable is uncollectible. So that means we're using the percent of receivables method. Remember, the percent of receivables method has that extra little step in there. We'll get to that in a bit. First, let's just record our journal entries. A, we sold merchandise on credit that cost us. So let's record that as one huge journal entry. We're going to record, I'm just going to call this A. We are going to record our accounts receivable for that huge number. And we are going to record sales. For the same number. That's A part 1. We need A part 2. I can do better than that. There we go. And this is the cost piece. So cost of goods sold and merchandise inventory. For the cost amount, $975,000. Okay, that's A. Next is B. B, we wrote off some uncollectible amount. So B, if this were the direct write-off method, here is where we hit the bad debt expense. But it's not. This is an allowance method. So we don't hit bad debt expense here. Instead, when we write off, we hit the allowance for doubtful accounts account. for 18,300, and we're going to pull that out of accounts receivable. Accounts receivable is an asset. When we reduce it, we do that with a credit. Because we're pulling that 18,300 out of our accounts receivable. We're pulling it out of our accounting system. We don't think we're going to collect it. C. Here we receive cash in payment of accounts receivable. So we're going to record the cash in, and we're going to reduce the accounts receivable because a bunch of people have paid us for 669,200. Okay, now D. D says, in adjusting the accounts, so these are adjusting journal entries at the end of the month. When we are using an allowance method, this is part of our adjusting journal entries at the end of the month or year or however often we have however long we have our accounting period. So on December 31st, we make our adjusting journal entry for the allowance for doubtful accounts account. It is 1.5% of accounts receivable. It didn't tell us what accounts receivable is, so we need to figure that out for ourselves. So accounts receivable, let me see if I can squeeze it all up here. Accounts receivable beginning balance. Brand new. We began operations in year 1, so there was no sales before this year. So we're going to start with 0 accounts receivable. And look at our journal entries, and that'll tell us. In A, we had sales of $1345,434. And that was A. I'm just looking for every time I hit accounts receivable. And B, we had a write-off. So accounts receivable write-off for $18,300. That's a reduction to accounts receivable. And in C, we had a collection. Accounts receivable collection. 669,200. 669,200. And that's also a subtraction because it's a collection. This is going to tell me what my ending balance is in accounts receivable. Let's see, I'm going to move this over here. So 0 plus 1345,434 minus 18,300 minus 669,200. 657,934. 657,934. The problem tells us that our estimate for uncollectibles is going to be 1.5% of that. So times 1.5% times 0.015 is 98.69. 98.69, it says round to the nearest dollar. So 98.69. When we're using the percent of receivables or the percent of aging receivables method, this is our desired ADA. That's how much we want the allowance for doubtful accounts account to end the year at. 9869. So we need to look at where our ADA account is right now. So I'm going to go ADA beginning. 0. Brand new company, just began operations in year 1. We didn't have any carryover from last year. I'm going to go through here and look for every time we hit the ADA account in our journal entries. So nothing in A1, nothing in A2. We hit it in B. Remember, the allowance for doubtful accounts account is a contra asset account. So when we debit it, that means we're using some of it up. So 18,300 is ADA write-off, is where we use some of that up. You can do this different ways. I'm going to do it this way, but you should find the way that you're most comfortable with and do it that way. Not leaving myself a lot of room here. The allowance for doubtful accounts ending balance, we want it to be 9869. It is currently at negative 18,300. So we need to get it out of the negatives, past 0, over to 9869. So I'm going to add those numbers together. 18,300 and 9869. 28,169. $28,169 is our debit to bad debt expense and our credit to the ADA account. That gets us to our desired ending balance of $98,69. That's year 1. I'm going to shrink this a little bit. Hopefully that's not too shrunken. Okay. And hit year 2. So in year 2, a lot of these are going to be very similar. I think they're probably even going to be the exact same, just the number's going to be different. So I'm going to go through it a little bit faster now. We've got E. In E, we sold 1.5 million in merchandise that cost us 1.25 million. So E, we're going to write the accounts receivable and sales journal entry. for 1525634. Those are our credit sales. I'm going to move this word over a hair. So we can tell that that's definitely our credit. There we go. So there's the revenue piece of E. We also have to record the cost piece of E. It cost us $1.25 million. So we're going to record cost of goods sold for $1,250, and we're going to pull it out of merchandise inventory for $1,250. That's the second part of E. F. We wrote off $27,800 in uncollectible accounts receivable. So if this were direct, this is where we would record bad debt expense. But this is not direct, this is an allowance method. Specifically, this is percent of receivables method. So we're going to hit the ADA account. We're going to use up some of our ADA account for $27,800. And pull it out of accounts receivable. And then G, collection. So debit cash for $1,204,600. And credit accounts receivable, we're reducing it. Customers made this big payment. $1,204,600. So there's E, F, and G. Now it is time for H. And H is the same. There's no new information in there. There's no difference between D and H. For our adjusting journal entry at the end of the accounting period, we estimate that 1.5% of accounts receivable is going to be uncollectible. So now we need to do that same piece that we did in year one. We need to do that again for year two. So I'm going to start off with my ADA beginning balance. And that's just my ending balance from last year. I think I might need to move that over a hair. That's just my ending balance from last year, which is $998.69. And then I go through E, F, and G, and I look for, oh, I messed something up here. I don't want ADA already. I start off with accounts receivable. I'll do ADA, but I'll do that in a second. First, I want my accounts receivable. And my accounts receivable ending balance is right there. $657,934. $657,934. Okay, sorry about that. $657,934. That's where we ended last year accounts receivable. That's where we're going to begin this year accounts receivable. And now I go through E, F, and G looking for accounts receivable. So E, I've got accounts receivable sales of 1525634. And then that's E1, nothing in E2. In F, I've got accounts receivable write-off for $27,800. That's reducing my accounts receivable. And remember, debits increase accounts receivable, so the debit for 15,25634 is a positive number. Credits reduce accounts receivable. So that's 27,800, and in G, the 12,04600, those are going to be negative numbers. And this, I got that right here, accounts receivable, collections. 12,04600. Now I'm ready for my new accounts receivable ending balance. $657,934 plus 25,634 minus 27,800 and 12,04600. 951,168. 951,168 times the 1.5%, so I can get to my estimate, my estimated bad debt, which is going to be my desired allowance for doubtful accounts ending balance amount. So that times 0.015. So I'm going to make this 14,268. Round it to the nearest dollar. That's up to 268. 14,268. That's my desired ADA. Now I can start with my, I'm going to use a different color here because I'm writing so close. I'm going to use black. Now I can start with my ADA from last year. Plus or minus any ADA from this year in E, F, and G. So E1, no ADA. E2, no ADA. F, I debited ADA. That means I used some of it up. So ADA write-off, 27,800. And nothing in G. So right now I'm sitting at 9,869 minus 27,800. So right now I'm sitting at a negative 17,931. I want to be at a positive 14,268. So I'm going to have to add those numbers. 14,268 and 17,931 is 32,199. That's my adjustment. 32,199. So let me go ahead and write the journal entry. This is H, and I'm going to debit bad debt expense for 32,199. And I'm going to credit allowance for doubtful accounts account for the same amount. Okay, that's it.